6 thought leaders in today's financial markets will discuss their take on the economy and their outlook for the financial markets. Roundtable Prime will divide the discussion into 3 segments. The roundtable guests, with decades in the financial markets, are recognized leaders in macroeconomic analysis, market research, and investment management. They bring together a broad array in different sectors of the financial markets, including government fixed income, credit, equities, real estate, and commodities. All have been sought after for their insights as speakers and as commentators in the financial media. And now, DoubleLine is pleased to introduce the honored guests of Roundtable Prime, our moderator and our host. Jeffrey Sherman will moderate today's discussions. Jeffrey Sherman is Deputy Chief Investment Officer of DoubleLine Capital and a portfolio manager of a number of DoubleLine's fixed income and derivatives-based strategies. He also hosts the Sherman Show podcast series, which has featured many of today's distinguished guests. Ed Hyman is chairman of Evercore ISI, where he heads the economic research team. For the past 44 years, Ed has been ranked by Institutional Investor Poll of Investors for Economics and ranked number 1 for 39 years. Ed Hyman is highly regarded for his origination of econometric modeling and real-time surveys to gain insight into the unfolding business and market cycles. James Bianco is president and macro strategist at Bianco Research, which he established with the aim of originating insights unencumbered by traditional Wall Street research. His commentaries address such diverse subjects as monetary policy, the intersection of markets and politics, fund flows, and asset allocation. Jeffrey Gundlach, host of Roundtable Prime, is founder and CEO of DoubleLine Capital, an investment manager with investment strategies in fixed income, equity, real estate, and commodities. In 2012, 2015, and 2016, he was named to Bloomberg Magazine's 50 Most Influential. In 2017, he was inducted into the FIA-SI Fixed Income Hall of Fame. Danielle DiMartino Booth is CEO and Chief Strategist for Quill Intelligence, a research and analytics firm whose commentary appears in the Daily Feather and the Weekly Quill. Prior to Quill, she served throughout the credit crisis as advisor to Richard Fisher, president of the Federal Reserve Bank of Dallas. She is author of Fed Up, an insider's take on why the Fed is bad for America. David Rosenberg is chief economist and strategist of Rosenberg Research and Associates, an economic consulting firm providing analysis and insights to help investors make well-informed decisions. Prior to founding the firm, he was chief economist and strategist at Gluskin Sheff and Associates. From 2002 to 2009, he held those positions at Merrill Lynch in New York, where he was consistently ranked in the Institutional Investor All-Star Analysis rankings. Jeffrey Sherman, Deputy Chief Investment Officer of DoubleLine.
What great thought leaders all of you are. Ed, David, Jim, Danielle, Jeffrey. You guys are all just great thought leaders to bring us together. But let's pull it all together. Let's give the clients what they want. Let's give the people what they want. I want to hear what's your best idea for 2022. And Ed, you're on my screen up there, so I want to start with you. You get to lead us off, and everybody can go relative to you. But what is your best idea, or what do you think people should be positioning for if you don't have just a best idea for 2022?
By best idea, you mean a stock idea?
It could be a stock idea. It could be whatever you like. You can. It just needs to be investable.
Okay, so I think if listening to all of you, I think I would pick Amazon. It's been a real laggard, and I think it's sort of at the heart of what's going to happen in the economy in the future. And this is not exactly my wheelhouse, but you asked, so that'd be my entry.
Okay, Rosie, to you, sir.
Well, am I limited to just one?
You can give me all of them as long as they're under 2 minutes cumulatively.
That's struggle.
That's tough for you, I know, to give me a 2-minute answer. So
Let's switch to Swahili now. So, okay. So look, I obviously I like the long bond. So I think that the Fed's going to pull the policy mistake, big fiscal drag, and what I'm going to buy on price dips, the moves in bonds we've had in the past couple of days. So I like the long bond. You asked before about income, which I don't think was completely answered. But within the stock market, I like utilities. I like pipelines. I would say that I would add, something that's got a massive tailwind that pays off very nice cash flows is self-storage space. Something I know that Danielle, I think, has written on is industrial REITs. So there are ways, actually, you can squeeze income. I'm not buying bonds, by the way, for the yield, okay? But I can find parts of the stock market for yield. We talked about emerging markets before. One giant that we didn't talk about that is, I find very interesting, where inflation has actually broken down and is in India. And so I'm closely looking, and we're writing more and more about Indian stocks and Indian bonds because we're noticing structural shifts in the economy. It's true that Modi's reforms have been slowed, but they have been accumulating over the years. We've detected in India something interesting, which is that their potential non-inflationary growth rate has gone up. And that's very bullish for their financial assets. So that is on our radar screen within the emerging market space for the coming year.
Well, I thank you for that. And those were a lot of ideas, and I think you came in right under 2 minutes. So I appreciate that too. So thank you. Jim.
I'm going to agree with Rosie about a policy mistake coming next year. And I'll go back to what I said at the beginning. The Fed is under enormous political pressure to at least appear to be doing something. The last thing they can ever do is say, don't worry, it's transitory. Hey, the stock market's going up. Sorry, you only have $1,000 of savings and you have to spend more at the grocery store. They're going to do too much. So flattening yield curve would be story one. Potentially second half, an inversion of the 2s10s curve is my first one. Second one, we talked about this earlier. I'll agree with Rosie. There's a high cyclicality to value versus growth. Value stocks had their worst 10-year period ever until their low in late 2020 before they've rebounded. They completely decimated the whole idea of being a value manager at some point. I think from a mean reversion standpoint, the return of value relative to growth that began 18 months ago will continue through the year. I only hope that that's not a call where you lost less in value than you would have lost in growth. That could very well be the case, but I think from a relative performance that the value stocks will continue to do better. Lastly, I would go you one step further. I am a long-term hodler. I believe in the digital space. I think the digital space is going to be something that is going to have to be reckoned with from the traditional financial space. But I think what we've seen in the last several months out of the digital space continues, and that is sideways to maybe down. And it's going to be a frustration for people as we move forward from here. If I give you one quick positive about the digital space, more money came into digital VC money and startup money in 21 than every other year combined. What does that mean? That means if they have another major bear market in digital, they've got the firepower to keep innovating, keep innovating, keep doing new ideas, keep the space moving forward. It isn't just we only work if these tokens keep going up in price. They've got the ability to keep going. That's kind of what happened in 2018 too. There was a bunch of money came in through initial coin offerings in 2017. The sector blew up. But a lot of the stuff that has been powering DeFi, for example, was created in that bear market from those initial coin offering money and stuff. So I wouldn't be surprised if the frustration sets in on digital or crypto. It doesn't do anything, maybe trades a little bit sideways. But long term, I still think it's definitely a good place to be.
Sounds like you want to be short Lambos too then, right?
Yeah.
Right. Danielle, to you.
Only the yellow one.
Only the yellow ones. Well, there's no
Okay.
other color, right? It has to be yellow.
So I'm going to go one step further than Jim. I'm going to borrow from the Lacey Hunt school of thought, and that's that the multiplier effect of the Fed removing liquidity from the market is about 3 times. So we've seen, again, M4 money growth slow from 30.6% in June of 2020 to 5% in November. We haven't even seen the effect of the taper in money supply growth. I think money supply growth itself could turn negative, and that could be a first half story. So I think the curve is going to flatten on more rapidly than most people are anticipating, which is going to make life more difficult for Jay Powell going forward. And one of the things that I'm watching as an indicator is the MOVE index, which, as much as the VIX index has come back down, the MOVE index has stayed elevated, and that's telling you that there could be a credit hiccup sometime in the second half of the year after coming off of a year when we really saw no bankruptcies in 2021. The other thing that I would suggest is that there is still fiscal monies to be spent. And I look at the Manchin factor, and you look at all the stocks that would have benefited from the infrastructure spending, they've taken off largely. They're largely at their 52-week highs. But I think states and municipalities, I think municipal bonds are going to be a good place to be because they're going to be actual physical recipients of monies in this coming year. And I think that there's going to be value to be had in that arena. And finally, I would say that there's a lot of scrutiny now for the office space. And there are a lot more reports being written about the vulnerability of the office space and parallels being drawn between office and retail. I think that's the wrong parallel. I think you need to draw the parallel between office and multifamily, because one has followed the other. So massive office developments have been accompanied by massive multifamily high-rise developments. As Rosie said earlier on in the macro session, the supply coming online is at a 47-year high. So I think it's more of a second half event, but I think multifamily trading at 2% multiple cap rates, I think it's a very vulnerable sector after we see the carnage begin in office.
Okay. And Jeffrey, we'll close it with you.
I think for relatively low risk assets, I would prefer European stocks. I think for high risk assets, I think investors should start dollar cost averaging into emerging markets, ex-China, and I would overweight India. I agree with Rosie. I've been a long-term India bull, and I'm not talking about 5 years. I'm talking about 35 years into the future.
Yeah. I think
and you should hedge that with the long bond.
With the long bond, yeah.
Yes, you should own at least 25% of your assets in long treasuries for the deflation hedge.
Yeah. One thing I would add to Rosie's too, if for those looking for income, I think you should be looking at selling calls too on stock markets as well. Just given where we are in the cycle and everybody's talking about the growth story, it could be a potential way to augment
where there's
as well.
yield, but it comes with attendant risk, of course, is in closed-end bond funds. Right. That's where there's yield, and for individual investors, you can buy them. For large money interests, you can't because you'll push the price up tremendously. But you can buy them. We have some of our own, and there are many closed-end funds that are trading at discounts and are kicking off yields of about 7 to 8%. So that's where you can get income. But it comes with risk. When there's a credit event, you're gonna have a drawdown that's probably 25%. Right. So be aware that income does come with volatility.
It looks like a drawdown of an equity market,
yeah.
right?
But at least you're getting 4 times the yield or 3 times the yield of the S&P 500.
Yeah. Okay. Well, I want to thank everybody once again, to all our guests. Thank you so much, especially those coming in remote. For those of you that flew in, thank you so much. Hopefully everyone enjoyed this latest session of Roundtable Prime. We'll be back again next year in 2023. We will look at the scoreboard, who's right, who's wrong, and we'll do it all again. So thanks, everyone, and good luck out there.
Thanks, Sherman.